the market is there to serve you and not to instruct you. That's of enormous importance. When people talk about momentum in stocks or charting or any kind of things like that, they're saying that the market is instructing you. The market doesn't instruct us. The market is there to serve us. If it does something silly, we get a chance to do something because it's doing something silly, we do it. But it doesn't tell us anything. It just tells us prices. And if the price is out of line with where the facts and reasoning lead you, then action is called for. And if it doesn't, you forget it and, go play bridge that day and the next day see whether there's something new. And the nice thing about it is there always is something new. I mentioned the LTCM crisis. We on Sunday from people that had portfolios that were in trouble. Now, I will tell you that if you can make a lot of money on Sunday, you may not get a chance very often, but any calls you get on Sunday, you're probably going to make money on. things are really screwed up if you're getting calls on Sunday. And all you have to do is make sure that you're the callee and not the caller on Sunday. But if you get those calls, you get a call on a Sunday and somebody says that the off the run is trading 30 basis points away from the on the run, all you have to do is decide how you handle that particular piece of information, whether it's correct in the first place, but how you handle that piece of information, whether you can play out your hand. You never get in a position, obviously, where the other fellow can call your tune. You have to be able to play out your hand under all circumstances. But if you can play out your hand, and you've got the right facts, and you reason by yourself, and you let the market serve you and not instruct you, you can't miss. Charlie?
Well, I would say some of you probably can miss.
I would say Charlie can't miss, I'll put it that way. He'll agree with that.
You've so eloquently stated that you can't see who's swimming naked until the tide goes out. Could you discuss the issue of trying to employ a rational decision-making process in investing or in business generally, as opposed to focusing on outcomes or results of just a few instances or over a short period of time? For example, it may not be a good idea to underwrite some insurance policies if competition has lowered the premiums too far. And likewise, in the stock market, momentum investors may get good results for a while, but buying high and trying to sell higher isn't a good long-term strategy. So I'd just like to hear you guys provide some detail on the importance of using an effective decision-making process, even though it may lead to some bad outcomes and underperformance in the short run.
Yeah, well, Ben Graham said long ago that you're neither right nor wrong because people agree with you or disagree with you. In other words, being contrarian has no special virtue over being a trend follower. You're right because your facts and reasoning are right. So all you do is you try to make sure that the facts you have are correct, and that's usually pretty easy to do in this country. I mean, the information is available on all kinds of things. Internet makes it even easier. And then once you have the facts, you got to think through what they mean. And you don't take a public opinion survey. You don't pay attention to things that are unimportant. I mean, what you're looking for is things that are important and knowable. If something's important but unknowable, forget it. I mean, it may be important, to know whether somebody's going to drop a nuclear weapon tomorrow, but it's unknowable. It may be all kinds of things. But so and there are all kinds of things that are knowable but are unimportant. In focusing on business and investment decisions, you try to you narrow it down to the things that are knowable and important, and then you decide whether you have information of sufficient value that, compared to price and all that will cause you to act. What others are doing means nothing. It's price and all that will cause you to act. What others are doing means nothing.
Jeremy Siegel had some ideas in his second book, and I would like to understand how this would impact your investment strategies, if there are any changes from his ideas, and how you react to these recommendations that he makes. Thank you.
This is which book? Jeremy Siegel?
Jeremy Siegel, the second book, while the try and the true triumph over the old and the new.
No, it's had no effect on us. Charlie?
No, is that the fellow who is very optimistic about common stock investment over long periods of time?
The University of Pennsylvania, yeah.
Yeah. Well, I think he's demented.
Well, he's a very nice guy, Charlie.
Well, he may well be a very nice guy, but he's comparing apples against elephants and trying to make accurate projections.
Number 10. The one thing we haven't done is we haven't participated in any auctions. I get books occasionally on various businesses, and the projections are just plain silly in these books. I mean, maybe that's why they don't sign their names in the books, the people that write them, because they'd be embarrassed about the projections they put forth. I would just love to meet the people that write those investment banking books and make them a bet on the earnings that they project 4 years out. I would win a lot of money over time. They wouldn't be met. But we get the calls occasionally from the people that care about where their businesses end up. We're going to close on Applied Underwriters in just probably a few days. And those are two terrific guys. Built it up from absolutely nothing. Actually bought a tiny business here in Omaha, as I explained in the report, that's why it's here. But they wanted to come with Berkshire. They think they're keeping 19% of the company. They think their own future will be the best in many ways, including financially, I'm sure, of being associated with us. They feel it's the best place for the people, have the most opportunity to grow. And, they came to us directly. And, I don't know how many stories you read about a $4 billion deal as appeared today in connection with this car where, it doesn't say anything about an investment banker on either side. But you'll see more of those, I think, with Berkshire over the years. Charlie, do you have anything particular to add on our acquisitions recently?
Well, the interesting thing about it to me is the mindset. With all of these new helpers in the world, they talk about doing deals. That is not the mindset at Berkshire. We are trying to welcome partners. It's a totally different mindset. The guy who's doing a deal, he wants to do the deal and unwind the deal and not too far ahead and make a large profit, etc. And that's not our mindset at all. We like the things that we can buy and that never leave us, and we like the relationships that last and are fruitful, not just for us, but for the people working there and the customers and everybody else. I think our system is going to work better long term than flipping a lot of deals. And we have so many new deal flippers in the game that I think they're going to get in one another's way. In other words, I don't think there's enough money out there to have all this new class make all the money they expect to make on a permanent basis, just flipping.
They'll make it on fees.
One reminds me, once I asked a man who just left a large investment bank, and I said, how does your firm make its money? He said, off the top, off the bottom, off both sides, and in the middle.
I know which firm he's talking about, too.
That's not our culture, and a lot of you have been here so long, you can see that's not our culture, but in the end, it may be that Omaha will do better than Wall Street.
Number 5.